Hi, everyone. It's about a week later, and I'm back for part two of the intensive deep dive into bank balance sheets and balance sheet risk. And it's been an enormous amount of fun for me and learning for me. So I've chatted with Eric for a couple of minutes now. And Eric, you're going to do a sort of a quick recap of where we've been before moving on to where we're going. So over to you.
Thank you, Guy. Huge pleasure to be back for part two, and thanks for watching. So we did IRBB in a nutshell here. We talked quite a bit about the regulatory framework last time. We also took a deep dive into UBS's balance sheet before the merger, went through the different categories of products and assets and liabilities on the balance sheet. We talked about the three risks: gap risk, basis risk, and option risk. And that's essentially it. So we covered regulatory framework, risks, and products. Today, we'll start digging into the metrics of interest rate risk in the banking book. So how do you measure the risk in IRRBB and asset liability management? And then we'll see how far we'll get.
We'll see how many rabbit holes I take you down. And very briefly, so Eric talked about IRRBB, interest rate risk in the banking book. Just again, this is in part to make sure that I've understood. Why are we looking at the banking book? And maybe if you can just flip back to the UBS balance sheet, just so that we can remind ourselves of where we are. We are looking at the loans and advances to customers and how those loans and advances to customers are funded. When you have a market instrument that is in a liquid market, there's a lot of information that one can infer from that liquid market. But my understanding would be, Eric, that whether it comes to customer deposits or loans, market measures don't apply, but banks still have to figure out the risk associated with them. And that's kind of where you're focusing on. Have I got that right?
Yes. So in contrast to assets that you have in the trading book or the trading portfolio, loans and advances would generally not be fair valued. So you would have accrual accounting. That's the two examples we talked about in the first episode, the Silicon Valley Bank crisis and also the savings and loan crisis. And without marking to market, you still have economic risk in these
Yeah.
assets. So yeah,
Yeah. So
and
thank you.
that needs management.
Yeah. And then another just brief recap. If you go back to your original slide with three different kinds of risk, why don't you just give a very brief recap on what risks we're talking about?
Sure.
You talked about gap risk. There we go. That's it. Yes. Go ahead.
So we have gap risk, which is the difference in timing of your instruments. That's really the key risk that materialized in Silicon Valley Bank, but also in the savings and loan crisis. So the banks had longer duration assets and shorter duration funding, which means funding is repricing at a quicker pace. And if rates rise, this is what happened for Silicon Valley Bank and for the savings and loan crisis, then the assets that are funded still earn the same return, but you need to fund them by liabilities that become pricier and pricier. So your net profit or the net interest income that you're earning is decreasing and even becomes negative at some point.
And just to give a sort of like a personal home finance perspective on it, in the US, when you could, it's the law that you can prepay mortgages. As somebody who borrowed in a declining interest rate environment feels really good every year or two, reducing their borrowing cost by refinancing their mortgage. That would be, that would be an asset liability, taking advantage of something on your liability side of your balance sheet for the personal, on the individual side. And at the same time, anybody who's borrowed against a home and the loans coming due and interest rates have risen are going to be uncomfortable because they're going to be looking at a higher mortgage rate. They'll, of course, seek to extend it as much as possible. So I guess that's from an individual finance perspective. The counterparty to every one of those transactions is the banking system, and they have to manage that risk effectively.
Yeah.
So,
And
yeah.
that's option risk. That's one of the types of option risk because you have the option to prepay your mortgage, and that will change the cash flow that the bank was expecting to get.
So
The
gap
second,
risk just assumes that you've got assets and liabilities. Option risk is the duration of the asset. Well, you go ahead and explain it. We've done gap risk. Now go to the other two.
so gap risk simply assumes that the mortgage is going to be paid as contractually defined. And if that's the case, there can still be interest rate risk because let's say the bank, and we'll have examples of that later, the bank has financed a longer duration mortgage with a shorter duration liability. The option risk arises if customers then decide to prepay, or the option risk, the most important one is around non-maturing deposits. So your sight deposits, current accounts, where customers have the option to withdraw. And the bank has the option to change the interest rate paid on these deposits. So there is optionality from the client perspective in terms of either prepaying the mortgage or in terms of withdrawing sight deposits. And there's optionality from the bank's perspective in terms of changing rates on deposits.
So very briefly, in a US mortgage, by law, you're allowed to prepay whenever you like. In a Swiss mortgage, you can't. I think that when we talk about options, many products and many contracts have options embedded in them. And often the option goes one way, either for you or against you. Most often, if you're not aware of the option, it goes against you. And you only discover that later. So options are, we all know about traded options or equity options, but options exist inside all sorts of contracts that we don't realize. The right to walk away and or not the right not to, or the obligation not to walk away. So anyway, option risk, and then at last we have just explain basis risk.
Basis risk is the risk that, let's assume you've completely managed gap risk. So all of your assets and liabilities reprice at the same time, then you don't have gap risk. But if, let's say you've issued Swiss franc mortgages, but you're funding them with dollars, and let's forget about the FX risk in that. But by virtue of having two different indices, so your asset side would reprice on Swiss francs, but the liability side on dollars, you have a basis risk if these two rates move differently. There is also basis risk between, for instance, administered rates on your non-maturing deposits and, let's say, SARON, for instance. The key basis risk in the past was between OIS, so overnight index swaps, and LIBOR rates. This is somewhat relevant still for the Nordic countries because you have some IBOR rates that still get quoted there, but it's on dollars and pounds, the LIBOR transition has gotten rid of the IBOR rates. So the classical LIBOR OIS spread is gone.
Now, a brief explanation for me. We're talking now about the market value of an instrument. So the market value of an instrument, if you're in the trading book or in anything that's liquid, of course, the market value of the instrument moves and we can look at the price because there's a market price for it. So we're talking here about, so it's the basis of what kind of instrument?
All of your instruments that have interest rate risk will have an interest rate attached to it. And that's essentially the basis. So it could be 6 months LIBOR, it could be 3 months LIBOR, it can be Ester. You can have an Ester Euribor basis in euros, for instance, because some assets reprice on Ester, some on Euribor, and then if the spread between these two moves, you will have a P&L impact.
Yeah. So okay. So last thing for me, when we talk about gap risk, a term that comes up for me, which I'm sure you use all the time, that something is match funded.
Mm-hmm.
So if somebody says these items are match funded, what
You're
does that mean?
anticipating 10
Oh, okay.
slides.
Good. Okay. Thank you. Apologies. Back to you. You got the mic, you got control. I'm going to be quiet.
Perfect. So let's jump into the metrics. So delta NII and delta EVE. I'll go through them step by step and how they're built. These are the two metrics. So net interest income, that's an earnings perspective, and it looks at the cash flows that you get in nominal terms. Economic value is different. It looks at the net present value of the cash flows. So you're discounting them, and future cash flows are worth less under an upward steeping yield curve, of course. Now, NII, to begin with, is the net interest income. So it's the net between your interest income and interest expenses. And that you simulate usually between 1 to 5 years. And then there's different ways you can simulate it. You can simulate it with a static balance sheet. That means if you simulate over 2 years and you have a loan that's 1 year left in terms of maturity, when that loan ends after the first year of simulation, then you replace it with a new identical loan. And if it was a 10-year loan, that means you'll replace it with a new 10-year loan. You can also have dynamic modeling. This would mean that the balance sheet can change as a function of your interest rate scenarios. So you would not necessarily have like-for-like replacement, as in the static balance sheet, but you could have more dynamic replacement and customer behavior that comes in. EVE is generally assumed under a runoff balance sheet because EVE, you're net present valuing the full balance sheet. So you don't take a 1 to 5 year horizon, but you look at a snapshot of the balance sheet today. You look at all of the cash flows from today until the last maturity, which can be up to 30 years for some swaps, for instance. And then you net present value all of that, meaning both the assets and the liabilities. Then you subtract the net present value of the liabilities from the net present value of the assets, and that gives you your economic value of equity.
So if I may,
Sure.
net interest income would be, it's a cash flow measure, basically.
Yes.
And it's just showing how much cash is coming in versus how much cash is going out.
Exactly.
And of course, it doesn't take any, I mean, you can write instruments that have all sorts of, it probably makes a distinguish between, does it distinguish between amortizing loans? Would you treat the
Yes.
amortization portion of the payment differently?
So it treats all of the cash flows as they come in. So if you have an amortizing loan, you will have both the interest payment and the principal payment.
So it's a very rough
that's
measure, effectively. I mean, if you wanted to be careful, you would separate out your interest payment, the interest on the principal versus the repayment of the principal. It would be, those are kind of different in nature. So to go to the second one, anybody who's run a spreadsheet, a discounted cash flow knows that the EVE is so unbelievably sensitive to the interest rate that you put in, especially if you've got something like 30 years. No, it doesn't matter. I mean, most of the cash flows, most of what contributes to the economic value of the equity goes out no more than 10 years. The sort of leftover, but the interest rate you assume makes a huge difference, huge difference. Yes. So what interest rate do you apply to those cash flows?
There's different ways to do it. Regulation generally expects you to be consistent. So that means if you look at what you're earning on assets and you consider that to be risk-free, so you extract the risky margin that you earn on these assets, then you're supposed to use also risk-free discounting, such that you have a consistency between earnings on the assets and the discounting thereof. If, however, you're considering your margin that you earn in the cash flows for EVE, then you're supposed to use risky discounting. So then you should discount it with a non-risk-free curve, but if curve that includes sort of funding spreads and others. The most common way to do it, though, is using risk-free rates.
Yeah, I mean, I can totally understand that. If you've funded something using government bonds, let's say, or sorry, if you can't fund something using government bonds, but let's say that it's AAA rated debt from your bank, then it's close as, so you'd discount that. Well, you discount it at the rate at the cost of your capital, I presume, or the cost of your debt.
Yes. So often what you would use is your own funding curve.
So then on the asset side, I can imagine that I'm the banker, I've made the loan.
Mm-hmm.
And then there's Mr. Eric Schaanning, who's the risk guy, and he says, well, we're going to discount your loan at 15%. And by the way, it's not profitable. I'm going to say, such garbage. You can't discount it 15%. This is basis points above the risk-free rate.
That's funds transfer pricing. So and it's going to come in a couple of slides also how you're doing the funding between the treasury of the bank and the customer representatives that actually give the loans.
And anyway, so yes, let me
Yeah.
I'll stop foreseeing your questions and let you get through. Let you make progress, I think would be the term. So back to you.
So we've talked about NII and EVE, but the metrics that are regulatory metrics are delta NII and delta EVE. The only thing that changes is it's a difference of two metrics. So for delta NII, you look at the difference in NII under a baseline scenario and an adverse scenario. So you look at your interest income and you subtract the interest expense under the baseline scenario. That's today's yield curve. And then you have adverse scenarios. We'll get to these in a couple of slides where interest rates move. And then you recalculate your interest income and your interest expense under that scenario. And you take the difference of the two. And it's exactly the same idea for EVE. So you calculate net present value under a baseline, net present value under an adverse scenario, take the difference between the two, and that's delta EVE.
Yeah.
And the banks are required to state, that's where you get to risk appetite frameworks or risk appetite statements. Banks need to state their risk appetite both in terms of EVE and NII. And as a part of the IRRBB guidelines or regs, it's the board that's the ultimate owner for this risk appetite. So that can't be delegated down to lower levels. It's obviously lower levels that prepare this, but the board ultimately owns and takes the decision on risk appetite. And then another metric that's not regulatory prescribed, but that's something that banks, of course, monitor very closely. That's the net interest margin. So that's the ratio of NII to average interest earning assets, which is a measure of profitability, essentially.
Yeah. On just the banking book, or when you're talking about these measures on the banking book, or on everything?
These measures would generally be on the banking book,
Yeah.
because the trading book, you can have accrual accounted items, and you also do earn interest income on trading book assets. But by and large, this will really be about the banking book.
So you're about to move to the next slide. Before you move there, I just want to give a few comments. So sometimes people ask me, we have a position in Bank of America, and people ask me, oh, but how can you monitor what's going on inside the bank? It's too complicated and too difficult. And anybody who's looked at any one of these banks, I mean, I'm most familiar with Bank of America. I mean, the huge numbers of figures that are presented. There's a facetious thing that I say, which is, do you think, we should not be concerned about whether yes, in an ideal world, I would understand everything if I had the time, but the management themselves, there are span of control issues. I think that part of what I learn in talking to you is because we get some kind of insight into the kind of conversation. So Eric, you and or your department would be reporting to the board members who are responsible for this.
Yep.
And you can imagine that there are conversations going back between people in Eric's department and the board members in decisions on discount rates, for example, in order to model this stuff out. So that's it shows a degree of complexity. On the other side, from the perspective of the regulator and public interest, I've experienced myself that merely asking somebody to go through an exercise, merely going through an exercise myself, even when you're dealing with things that are very hard to measure, and you have to take estimates, or you have to make decisions, you get insights into what's going on, basically, based on your assumptions, and you see things that you wouldn't have otherwise seen. So I think at the end of the day, it's a good thing. But it's fun to basically get a kind of a window. It's sanitized of any particular bank, but you get a window onto the kinds of conversations that are producing the numbers that are being produced. And this is at the very core of what makes our financial system tick. I mean, it's kind of fascinating, really.
Yeah, and I think the Pillar 3 disclosures are becoming increasingly good because there's more standardization. There's also more granularity that's required. The EBA, for instance, has updated its disclosure requirements this year and is requesting banks to provide much more information, for instance, on the modeling of their non-maturing deposits and the duration thereof. So you can really peek much closer into these processes by virtue of these disclosures now.
Just for people who don't remember what Pillar 1 and 2 are, before you get to Pillar
Yes.
3, quick recap.
Pillar one is the minimum capital requirement. So that will be predominantly for credit risk in this context. So for each unit of loan that you issue, you have to hold an additional unit of capital. There is no such Pillar one requirement for interest rate risk in the banking book. Pillar two is about stress testing and the regulatory discourse or regulatory interactions. It's called SREP in the EU, so Supervisory Review and Evaluation Process. The regulator can give you an additional capital requirement if they think you're running excessive risks. And then Pillar three is simply public disclosures, so a set of metrics that every bank needs to disclose.
And before we move on, just a sort of like phenomenon that helped me to understand why money center banks are a kind of a franchise. Part of it is, and I've experienced this in my little investment management business, is that there is a public interest. There's a clear public interest and a desire to get banks to disclose risks. We run a fractional reserve banking system, and that in order not to have huge crises like 2008-9 or the 1930s crisis, we have improved disclosure, and we require significant institutions to do things. And so if you're not going to do those things, we're not going to allow you to operate within our financial center. So what's the result? Even I, a small institution, have to make certain reports. A large bank, has to make many, many reports. And as you can see, the regulatory framework changes. The regulators learn things through discussions with academics, through banks, through learning. And so the regulations change, and usually they become more stringent in one way or another. What's the end result? The end result is that if you want to remain in business, in financial services, in banking, you need to continually update your regulatory compliance, your risk management, your regulatory compliance. That's the kind of cost of being in business. And without anybody intending it to be that way, what that really does is it raises a barrier to entry, that somebody who wants to get into this business has to pass a whole bunch of regulatory barriers. They have to get the regulator on board with them. And so that becomes a kind of a franchise, a regulatory franchise. Another place, so it takes place in money center banks and all banks, takes place in pharma, for example. But I can see you want to comment on that, so go ahead.
No, it's true. I mean, you do see neobanks like N26, Banco, or Revolut that come into the market. You also see more service providers that sort of provide vendor solutions or off-the-shelf regulatory compliant programs and calculation engines. But then these also have a cost tied to them. So there is definitely a cost that's tied to the entry of into the banking market.
Yeah, thank you. I feel very privileged to be learning this, Eric. Thank you so much.
Well, the pleasure really is all mine. Maybe moving on to the supervisory outlier tests. This also ties back to Silicon Valley Bank, because this test was not applicable to Silicon Valley Bank. Or let me correct. The test was applicable to it, but the threshold was not. So the Basel Committee on Banking Supervision, BCBS, they prescribe 6 regulatory scenarios for economic value of equity. That's the EVE SOT. So there's many acronyms, unfortunately, in this whole area. And that test simply says delta EVE, which we defined before. So the difference in the economic value of equity of your balance sheet for 6 prescribed scenarios, that should not be more than 15% of your tier 1. If it's more than 15%, then you qualify as being an outlier bank, and you could be subject to supervisory measures, like the regulator asking you to put on more capital. They could ask you to hedge the risk, etc., etc. And going back to last session, we said that Silicon Valley Bank was running a 27.8%, I think, delta EVE risk relative to tier 1. So double, essentially, what they would have been allowed to hold in terms of interest rate risk under these regulations. By comparison, Credit Suisse at that time was running 3.6% of tier one, so about a fifth of what it's allowed or would have been allowed by regulation.
So briefly, BCBS, uh, so Bank of International Settlements is a kind of a bank, central bankers bank. Who
Yes.
sits on that committee? Who gets nominated? How does it get? Maybe you can just take a moment to give the governance of the BIS actually. Who controls it? Who runs it?
That's a good. Maybe we could take that in the as a follow up homework for me. I can give a brief answer. So the BCBS is generally run by central banks. You'll have generally a central bank governor who is the chair of the BCBS, and the BCBS is a standard setting forum. So they will agree on international standards, but they will not be applicable by law for banks. They need to be transposed into national legislation first to apply. And then there's often a question about level playing fields. So if you have the BCBS standards, the Basel III framework is the standard for banks in that sense, and all of the IRRBB regulations, they are part of the Basel III framework. How do you then, and what elements of that framework do you transpose into your regulation? And there can be differences for good reasons. For instance, you have Scandinavian banks that have a different interest rate profile. They have much shorter term loans than comparatively, for instance, Swiss and German banks, where they're lending much longer. So the risk profile of banks is different. You might have other national differences in terms of just how the banking sector is set up, and as a result, you can have reasons why you should deviate in implementing this. But this is intended to be a minimum standard at a global level.
If I'm going to have an attempt to explain to some of the people I imagine might be still with us at this point, and
Yep.
then you're gonna sort of correct where I've sort of like gotten it wrong, if you like. So in the developed countries, most of the ones that I know, we have central bank independence in that the key decision making is taken by people who are independent of political control, and their kind of KPIs, key performance index, is usually related to price stability and maybe full employment or economic growth. But and then I would say that people of a banking frame mindset have a just naturally a strong interest in seeing price stability and not seeing instabilities that rise, for example, in times like 2008-9 or in the 1930s or other crises. And so they tend to, and there's a huge proportion of a certain part of the economics profession that ends up being attracted to that. So a combination of people who might come out of risk management departments, senior bankers, people who have a strong interest in finance end up congregating around these institutions. Banks and central banks have a need to find common frameworks in order to decide what somebody else's, if you should lend to somebody or not, for example.
Mm.
And so it seems that in a way it's kind of it had to congregate somewhere. And all of those decisions kind of, or much of those meetings happen in around the BIS. There's no kind of formal authority that authorizes the Bank of International Settlements, but everybody kind of understands that that's the place where you go to sort these issues out. And so you get Basel framework. And then, of course, there are some banks that say, well, this shouldn't apply to us. It doesn't apply to us. We're going to lose money if we apply it. And then there's kind of discussions as to what kind of pressure you can bring on either banks or banks in a country to come into compliance with the Basel framework. And there are ways to exclude them in all sorts of ways that if you're not kind of meeting what the BIS group expects of you, then you could find that you're shut out of certain kinds of business or certain kind of trade. So I'll stop there because it's not something I've done a lot of reading about. But you say correct the bits that I've gotten wrong, if you like.
Yeah, I think it's really about making the financial system safer and having minimum standards around safety or risk management that allow this to function. The Basel Committee and also the Basel framework, think got a lot of attention after the global financial crisis. And that set off this review of Basel II, from Basel II to Basel III, and trying to essentially close some of the regulatory holes, if you will, that allowed the global financial crisis to happen. And as part of that, you had a large increase of focus on liquidity risk management. So, for instance, the LCR, the liquidity coverage ratio, and NSFR, the net stable funding ratio, these are two metrics that quantify how much liquidity risk a bank is taking. These are new metrics that came up after the GFC, because you saw in the financial crisis that banks that had excess capital and were meeting their capital requirements, like Bear Stearns, they still defaulted. And they defaulted because of liquidity risk. And that wasn't covered in the regulations before. So you need a regulatory body. Well, the BCBS is not a regulatory body, strictly speaking, but you need a place, a bit like the United Nations, where you go to sort out political issues at a global scale. You also need a forum to sort out financial system issues at a global scale. And then you try to reach an agreement there, which is the Basel framework, and then that gets implemented into international legislations.
So to get back to your slide, I have two questions.
Yes.
So you said that Silicon Valley Bank was running it. So, you kind of get tagged as being an outlier bank with delta EVE at 15%. And Silicon Valley Bank was at, did you say 30 somewhere?
28.
So this was by their own measure, because this is an internal test that you do. Were they reporting this number?
Yes, was publicly disclosed, and it's not by it. It's quite prescriptive how you calculate this. So even though you calculate it yourself, you have model validation functions that validate the models that you use to calculate this metric, and there will be high scrutiny on it because it's a regulatory metric that you have to publicly disclose. And so essentially all the banks, by a very good margin, they will calculate this in the same manner, and there is a reasonably high element of comparability, and it's also standardized shocks that you apply.
How long ago did this measure get placed into a requirement for banks?
I think 2016.
2016. So just to go back to Silicon Valley Bank, off the top of your head, are you able to describe why their measure was so much higher?
Yes. So EVE, because they had such a large portion of treasuries and residential mortgage-backed securities and other bonds that were earning a fixed rate. You earn a fixed rate, and if rates go up, which is one of the scenarios in the EVE supervisory outlier test, you're still going to earn the same rates. But if you look at the funding was short term for Silicon Valley, so they have to pay more.
So it was mainly this gap risk.
Exactly.
So this is pretty obvious.
That will show up in the EVE measure. And the shock, the standardized shock that's applied is one of them is a roughly 200 basis point parallel shock across. So parallel means just across all tenors. You increase the yield curve by 200 basis points or 2%. And under such a scenario, Silicon Valley Bank would have lost about 1/3 in net present value of its balance sheet, because
just to understand.
Oh yeah.
Yeah, sorry. We got that you've got sort of like you could short fund long duration bonds, and then interest rates go up, and the value of your long duration bonds drops significantly because they're long duration. That's in your trading book so here I'm imagining that they've got loans outstanding and they're being funded. I guess
no, you will hold bonds in your liquidity portfolio or liquidity buffers, these will generally sit in the in the banking book as well.
I see. Okay, so this is market tradable instruments in the banking book.
Yes.
And so this was just gap risk.
Yes.
And it's kind of shocking, really, isn't it?
It was just gap risk.
That's insane. So, okay, thank you. So, yeah, a great measure to look at.
Yes.
Do you know the names of some outlier banks today?
No. I mean, you'd very rarely want to be an outlier bank on these
Yeah,
tests.
yeah,
Um, I think there are a couple in Europe, but I wouldn't know the names.
yeah. So, okay, back to the presentation. Thank you for taking your
Yeah.
time with me.
On delta NII, the idea is exactly the same, just it's limited to two scenarios, parallel up and parallel down, rather than six. And we'll get to these six in a minute. And that's the EBA only that has the NII supervisory outlier test. This is not part of for instance, the Swiss regulations. The Swiss regulations for now focus on EVE only.
Yeah, which makes sense. I mean, we care about the solvency of the bank. We don't care about from a public policy perspective, we don't care about its profitability.
Yeah.
So if you're earning less money, then that's just fine. As long as you
Yeah.
don't go into, so long as you don't jeopardize the principle. So
Yes. I think the idea is if you're earning much less money over a certain amount of time, then that of course will also, or that can have solvency impacts. But these are the two metrics, the two
yeah,
dimensions. One interesting fact on the delta EVE measure, FINMA requires that additional tier one bonds are treated like equity. So if you have additional tier one bonds on your balance sheet and you hedge them with interest rate swaps, then you need to count the interest rate risk that generated by the swaps, but you can't consider the bonds themselves. So it looks a bit like you've got an open interest rate risk position, because you're only counting the hedges, but not the bond. The rationale being that if the additional tier one needs to be written off, it's gone, while you still have the swaps.
so I mean, just to put that into words that I can understand, 80 additional tier
AT1,
bonds.
additional tier one.
Yeah, they look like bonds, but in certain scenarios they convert automatically into equity without anybody having to do anything. And so it's a kind of way for a bank to raise capital,
Yeah.
regulatory capital, without having to issue equity. There are people who are willing to buy those bonds, but how do you treat them? That's kind of an example of this embedded option, and it's an option that can be exercised under certain conditions, which basically could wipe out 100%, as much as 100% of
Yes,
your
and
equity.
that's precisely what happened with Credit Suisse, where FINMA mandated that Credit Suisse write off the bonds.
And
And
and just
you have different types of bonds. You have bonds that can be written off, and then you have bonds that can be converted, sometimes also called COCOs. And these then get converted. So you become a shareholder after having been previously a creditor to the.
which, by the way, is if you were to go through, it's in a way, it's a kind of like a pre-packaging of a potential bankruptcy. And if you were to go to a bankruptcy court, they would take that level of bonds and convert it into equity. And so you're
Mm,
kind of just doing it ahead of time without having to go to court to do it,
exactly.
basically.
It's a bail-in measure,
Yeah.
essentially.
Um, but there's this contingent option there. And just as a quick aside, I happen to, he's not a close friend, but he's a personal acquaintance, is a lawyer who's representing the AT1 bonds in Credit
Oh,
Suisse, and about 20 billion of AT1 bonds were written off, if I
yeah.
remember, in Credit Suisse.
16,
And
I think.
yeah, and the issue, or part of the issue, that from public, just reading what is in the public domain perspective, is that the restructuring of Credit Suisse before UBS bought it was left some equity value for the shareholders, and
Mm.
the AT1 bond people say, well, if we lost everything, why did the shareholders get something? They were below us in the capital structure. But yeah, back to you.
It's an interesting question. And there's a paper, I think, by the Swiss Finance Institute that dives into that. The fine print said these could be written off without the shareholder having to be wiped out entirely. So from a legal perspective, now I'm not a lawyer, so I'm on thin ice, but I think from a legal perspective, it was perfectly fine. It just violates this common understanding that you generally wipe out shareholders before you wipe out bondholders. But the
I mean,
fine print did allow for it.
and I don't, I mean, the guy I know doing this is a very, very smart guy. One of the, there's some of these guys who do that kind of litigation or they got um their shit together, I guess. But from a very sort of basic perspective, no politician is going to want to write off a bunch of small shareholders. By contrast, they don't mind taking a bunch of very, very rich capitalist institutions out back and shooting them. That's the pure politics of it. I think anybody with any experience would have had to take that into account. And so in a way, I actually don't think that these AT1 bondholders have any much of a leg to stand on. It's not like the shareholders got that much anyway. But I think the main hammer or a hammer that they're going to try and hammer the Swiss government with, because this was mandated by the Swiss government,
Yes.
as I understand it, is that they'll want to make the claim that people should be wary of providing capital to Swiss institutions if the government mandates that people lower down in the capital structure, even if they can do it legally, are getting something, while people higher up in the capital structure are not. That does not show Switzerland to be a good place to do business if you're a provider of capital, something like that. But
Yeah.
I think that again, because we're talking about it, and I know, and this is my last question before you move on to the next slide, is that in the days leading up to the bankruptcy or to the restructuring of Credit Suisse, I don't want to use the term bankruptcy because, are they insolvent? Are they bankrupt? They were losing deposits at a very, very rapid rate. So people were moving their money away. And that would be that. So that's to go to your three different kinds of risk. That's option risk. That's people not renewing their deposits with the bank. Was that so? I guess, well, in a stressed scenario, you in a way, all bets are off. You don't know how many deposits are going to leave, do you?
You have liquidity stress testing that's trying to tackle exactly that question. And then for all different types of liabilities, you will have outflow rates. So you assume that a certain percentage of that's going to go. That's essentially the liquidity coverage ratio, the LCR. So you look at a 30-day horizon and you look at the ratio of high quality liquid assets, or HQLA. That's cash that you have on hand at the central bank. And then it's other assets that can be quickly converted into cash. So it's going to be government bonds and very highly rated securities. For instance, covered bonds in Scandi markets would also be in that category. So everything that you can use to quickly pay out money, you total that up and you divide it by your net stressed outflows over 30 days. Net stressed outflows is simply the difference between inflows and outflows. You're very conservative on what you're getting in, and then you assume outflows where some of it is just going to be mandated because you have scheduled payments that come due, but then there's also behavioral outflows, which are the more important ones, and then you stress those. That's the LCR. And in interest rate risk management, you can also you can include this. It's not in the EVE regulations. If you look at them, especially how they're spelled out in the EBA, there the requirement is that you should consider optionality and behavioral assumptions. So if if your internal models sort of predict that if rates do this or that, then customer behavior is likely to be this or that, that type of behavior should be included.
Yeah.
Generally, however, if you think about this idiosyncratic bank run risk, that's not included in EVE measures.
Yeah. You don't, and from a financial stability perspective, if you actually have a bank run, then the central bank can step in and
Yep.
effectively, if I remember correctly, I mean, implicitly or explicitly, the Swiss National Bank had stepped in, as other national banks had. And if we go back to the GFC, I like that. I'm starting to use your acronyms. The global financial crisis. I mean, in a period of about 2 weeks, whether it was AIG, the Freddie Mac
Yes.
and Fannie Mae, effectively the government or the unlimited funding was made available to them, whatever they needed. The
Yep.
government balance sheet, the country's balance sheet became these companies' balance sheets. But you kind of don't want to go there.
No, no. You try to stay away from that yeah, state.
I still find it utterly, it's kind of like miraculous that the central bank can create funding, can create money at the stroke of a pen,
Yes.
or at the movement of ones and zeros inside a computer. They just can make bank balances available. They can
Yes.
go to, so, you know, I don't know, we were talking about Credit Suisse. Credit Suisse has balances at the Swiss National Bank. The Swiss National Bank, from one day to the next, can just say your balances are double that, and they are double that.
Yeah, not the balance in of itself, but they can say you've got more cash,
Yeah. Uh,
and that will be well through repo facilities, so posting high quality collateral, and then I think that's also
or
what happened in the Credit Suisse case. I'm not entirely sure,
I mean,
but definitely during the GFC, banks also in and during the Norwegian banking crisis or the Scandinavian banking crisis, banks started to use their loan books as collateral.
yeah. I mean, to make sure I'm understanding it correctly. So, a no bank in a developed country would do it. In theory, they could just say, "Well, bring us whoever you want. We'll pay them out on your request." More specifically, they don't do that. They take collateral from you, and in return, they give you cash that you can then direct to wherever you like. And then the question is, what collateral do they take? And in
Yes.
general, central banks like to take AAA rated assets like mortgage-backed securities or government bonds would be even better. But what you were saying was that during the Scandinavian financial crisis, they were even willing to take corporate debt, for example, which is a different
and
risk
and and
category.
and mortgages, residential
Yeah,
mortgages.
yeah.
That,
It's
that's
kind of
that's a key
magical.
function of the central bank. The central bank, if a bank has a liquidity issue, the central bank should support it. So the central bank should provide essentially unlimited liquidity support against high quality collateral, such that the central bank doesn't take on credit risk. It's not supposed to support insolvent banks or bankrupt banks, but it's supposed to support banks that are solvent but illiquid.
Yeah. They didn't do it for Lehman Brothers, though.
No, but it wasn't clear. Well, Lehman Brothers was, I think, it was in excess of its capital requirement, but it wasn't clear whether the numbers then reflected actuality and whether the bank really was solvent. I think at the end, if you look, I don't know what the number is, but subtracting all of the legal fees, investors still got out something above 90 cents on the dollars. So probably Lehman was solvent.
I think that most of the people I've read who wrote about that period, the main one being, oh, I don't remember, he was Federal Reserve chairman. Oh, I'm blanking, but they would say that they made a mistake. They should have made funding available to Lehman Brothers. But this guy Richard Fuld was deeply unpopular with those policymakers, deeply, deeply unpopular, and they kind of just disliked Lehman Brothers, seems to me. But yeah. So I'm going to let you get back to the slides.
Yeah, I think we've covered this one. Just to mention that, yeah, supervisory expectations differ in terms of sophistication of banks. If you're a very simple retail bank, the degree of sophistication, how do you model customer behavior is going to be different from if you're a large systemic bank, and there's going to be larger scrutiny, and you'll be held to a higher standard in terms of your modeling and risk measurement capabilities.
Of course,
And
if
sorry.
I'm a systemic bank, I want all banks to do the same thing that I'm doing, and because that's going to put them all out of business, and then I'll win their business.
Yes.
And the smaller banks say, we're not a risk to the system, so you should let us go very, very
Yeah.
lightly. And all those big banks, they're a huge risk to the system, so we need to give them an extra capital charge and all sorts of things.
Yeah.
SIFIs.
SIFIs, exactly, or GSIBs.
SIFIs significance. Go on, you give the
Systemically
acronym.
important financial institution.
Yeah. And then
And
you gave
GSIB
another
is
one.
global systemically important bank.
Yeah.
Yeah, and that's sort of really the core of interest rate risk in the banking book. You try to risk manage or stabilize your income that's produced by assets versus the expenses you pay on the liabilities, but also not just looking at an income or earnings stream, you also take a value perspective. And that's again almost laboring the point, but the Silicon Valley Bank or the SNL crisis, the income stream was stable because they kept earning the same thing, but what they were kept earning was worth less because the funding had become more expensive. So from a value perspective, they were loss making.
Yeah.
And it's the combination of these two metrics. In terms of regulatory development, I don't know how long you want to dwell on this slide, and I'm not sure how well I would be versed in the far away history. I think the main point to mention on the historic maybe sounds almost a bit grandiose for interest rate risk in the banking book, but it's actually pretty young regulation, even though it's really the core. And I mentioned it's the cardiovascular system of a bank. So if you think about credit risk, there was much more regulation and much more clear expectation on how credit risk be managed in early days compared to interest rate risk in the banking book. Sort of, off you go manage your interest rate risk. And the regulations came really late. So if you look at the interest rate risk in the banking book as defined by the Basel Committee, that's BCBS 368. So on the 2016 line, that's when the Basel framework was published and finally agreed. And since then, different jurisdictions, they have then implemented these guidelines into their national law. So the EBA, for instance, implemented its guidelines in 2018. FINMA, it's called the Rundschreiben Banken Zinsrisiko. That's the 2019 circular. So in 2019, FINMA essentially transposed the BCBS rules on interest rate risk in the banking book. And that's a far way after the global financial crisis and also the savings and loan crisis. I just find that surprising almost,
Yeah.
that you did not have a more stringent and more explicit framework. I mean, there was, of course, if you look at the 1993 document, there was a consultative document on the measurement of banks' exposure to interest rate risk, which certainly was inspired by the savings and loan crisis before, but really the big regulatory bang, if you will, that was 2016 for interest rate risk in the banking book.
So you said you'd go and do some homework, which I'm delighted, because what I would like to understand is who's driving it. And I know that on some level, politicians are driving it. The kind of politicians say we had to, potentially compromise the taxpayer because you guys did a bunch of stuff. So we're going to come up with new regulations. But, my understanding of politicians of all countries is that their degree of understanding of this is not very good, probably far less than the understanding that we've established so far. And so how exactly that gets translated into regulations that then get implemented is kind of interesting for me. is it only the politicians driving it? Is it the academic community? Is it particular banks that measure well and now they want to level the playing field against other people?
It differs. I think the cycle is probably somewhat inspired by the last crisis. So you notice that a crisis happened and sort of, oh, there was this risk that we didn't really capture in an adequate way. Then the regulators and academics will generally go to the drawing board, think about what happened, how could this have been prevented, draw up new regulation that would prevent this. Then you have consultative documents that get published by the BCBS. You've got a commenting period, so there's consultations and then a request for comments where the industry, so the banking sector or the banking lobby will respond, but also academics and even individuals can respond to these. And then proposed rules or proposed regulations will get adapted as a function of that.
Yeah.
And the same process then happens when the EU is about to issue new legislation or new directives. They will put out a proposal. And there's a lengthy process also that involves the Parliament, the Commission, and the Council. But once they've agreed, there's also commenting by the public, and then a final legislation gets implemented and enters into force.
Actually, I have, because I've spent some time reading about it. And from the European Union perspective, I mean, look, they're kind of like the bureaucrats I know the best. These people really care about the good functioning of the financial system, so they're thinking very, very hard about it, and they don't want to be the person who, on their watch or under their watch, things developed in such a way that it went in the wrong way. So there's kind of impetus there, obviously, and it seems to me that the money center banks, the larger banks, they can absorb the costs of these things. And so it's not like they're against it. They do want to run profitable businesses, and they want their institutions to be successful, but when they're large enough, they can take all of they can eat all of the regulatory changes. They can put them through into their businesses. But yeah.
I would say you probably have advantages if you're bigger, because you have more resources to implement change, but you're also disadvantaged at the same time because you're more like an oil tanker. So you will likely have more legacy IT systems, and it will be more difficult to implement certain regulatory changes.
Yeah. Have you been to Jackson Hole, Wyoming? Would you go to that?
No, I would definitely go. No, I have not been invited yet.
Do you know how, so Jackson Hole, Wyoming, for reasons that maybe you can explain, Eric, is where central bankers get together once a year to talk to each
Yeah,
other. It's kind of like a Davos for central bankers.
exactly.
I don't know much about it. Maybe you can share as much as you know.
I think the Davos for central bankers is really it. It's it's a meeting. You will have academic presentations. You will have presentations by central bankers. The program generally gets published, and also the papers that are presented gets published. But I think the key point is they meet to discuss the current challenges in central banking, be they from a monetary policy perspective, so fighting inflation, but also they can also be related to financial stability issues. There was a pretty big and famous meeting or around the GFC where the question then was what regulations and how should regulations change in order to address some of the shortcomings. And for instance, there was a book, it's called the Squam Lake Report by a number of lots of high quality academics that I think that sprung out of or fed into the Jackson Hole meetings. Daryl Duffy, he's very focused on regulations and applying academic insights to improving regulations. So he's got papers and also a book that came out after the financial crisis called How Big Banks Fail and What to Do About It, which I found was a great read. It's a couple of years back already, but very insightful book.
I think that before we move on to the next portion of your sort of like intensive introduction to banks and banking risk, is that we're kind of deep in the plumbing, if you like. And Neil Ferguson talks about the killer apps of Western capitalism, and one of the killer apps, I would argue, is the ability to manage capital well. And again, I'm kind of like part of what I want to do is kind of make the bridge between what you're doing and maybe what some of my investors, other investors, would talk about and understand. I don't know, anybody who's visited a developing country will see an unfinished building just standing there. And you can see that the building started going up and then nothing happened for a long time. That's trapped capital in a very, very visible way for one reason or another, either because of planning permission or because of bankruptcy laws or because of some reason that building, a lot of capital went into bringing that building to a certain stage, and then something stopped it from continuing. That's trapped capital. And inside of a well-functioning capitalist system, like I would argue the Western capitalist democracies, it's a trade-off between having too much capital trapped in non-useful places and making the system very, very dangerous. And actually, we get an incredible balance. We do want to trap capital to create capital buffers, but we don't want too much capital trapped because we want it put out into productive activities in the economy. And what we see with these kinds of regulations and the kind of work that Eric does is we're trying to get that balance right. We're trying to trap enough capital inside the banks so that they can meet any contingency without trapping too much capital. And that, if we trap too much capital, we reduce incomes and we reduce the growth potential of the economy. If we trap too little, we can facilitate more growth, but at the risk of big financial crises. And it's complicated and it's not easy to figure out what the exact number is. But as you can see, great minds and a lot of minds come together to figure out something that is workable. And I don't know of any other system, certainly not socialism, certainly not communist Russia, that is doing such a good job at figuring that out, I guess. So just a little bit of overview there. And I think that what we find in developing markets is, as we're seeing in China right now, overdevelopment in certain areas, a whole bunch of real estate that's actually stranded real estate. Developing economies go through more financial crises than developed economies do. Why? Because they're still figuring that out, So, and forgive me, I'm meandering a little bit, but you're going to take us to the next slide after this, which will stop me from meandering. Something very powerful when a country like when the Eastern European countries joined the European Union, or if at some point in the future Ukraine joins the European Union, they're kind of like they're agreeing to bring on board. They kind of like backfill so many things that have been worked out where competing interests and trying to balance things have been sort of worked out in the rest of Europe, say, and now Czech Republic joins or Poland joins, and they backfill all of that. And the last time we saw, I mean, actually, and I haven't followed up on it, and maybe I'll sort of turn this into a question before you go to the next slide. So, two countries that got into trouble not that long ago were Spain and Greece, and again, so the stability of their financial systems wasn't what it ought to be, and Ireland had problems as well. In their case, they joined the euro, their borrowing costs went down, and a bunch of banks got into gap funding risk, and they funded a bunch of real estate that turned out not to be as valuable as they thought it was. But we're working through that, and so how do you develop a wealthy society in part by doing this kind of work inside banks?
That's a very tricky question. It's true that especially in Spain there were lots of defaults on I think especially also on holiday homes that were financed, and that led to a huge crash in the real estate market. By comparison, for instance, the Scandinavian the Scandinavian countries, they introduced so-called stress tests on affordability of mortgages. So in order to be eligible to get a mortgage, you had to be able to withstand a 5% interest rate hike and still afford the mortgage. And if you would not withstand that hike, you'd not be eligible for the mortgage. That was introduced after the Scandinavian banking crisis. And there's more borrower-based measures that are now being introduced broadly across Europe. There's quite a zoology of different measures. Some of them target banks, so preventing banks to issue loans, but some of them also prevent or are targeted at customers, like these borrower-based measures. And presumably, if more of these measures had been in place in Spain, you could have reduced the number of defaults on mortgages and on lending that the banks suffered there. And you also said it's a complex system. That reminds me of I think a funny quote by Max Planck, who's a Nobel Prize physicist and discoverer of quantum physics. He said I think before he got into physics, he said that he looked at economics, but then decided to drop it because he thought it was too complicated and too complex. So,
Yeah.
economic systems, because you have interacting particles, if you will, so both humans and institutions, but the complexity and the degrees of freedom with which these interactions can take place are orders of magnitude more complicated than if you think about atomic particles in physics.
Yeah. Yeah. And yeah. So if we just talk about Spain, you picked up on Spain. The joining the euro and some of these risks that were introduced into the economy, we should not forget that on the other side of that, there were a bunch of first time for homeowners. There was a bunch of real estate going in. There was increases in standard of living that were taking place. And so, yes, risk built up in the banking system, but there was also an enormous benefit. And we want to run the financial system in any country that we're associated with in a way that you don't get financial crises, but we don't want to. Let's just remember that the rule that says that you need to be able to withstand as an individual a 5% interest rate hike and still be able to afford your mortgage, on the one hand, protects the banking system if it's applied, but it cuts a whole bunch of people out of steps to home ownership, which is the other side of it. So, let's not forget that when the people who run the financial system get it wrong and a financial crisis happens, let's not forget the income that was created and the increases in standard of living that were created through those mistakes, if you like. So,
yes, yeah. And there
there you are. You're back at the starter slide. Back to you, Eric.
Yeah, it's a intermediate place for the slide. So now we'd get to the next section, sort of on fundamentals, where we talk a bit about rates and also the yield curve. So the yield curve really is, I would say, almost the central element of asset liability management and interest rate risk in the banking book. Generally, it will be upward sloping. So if I have $1 today, it's worth more than $1 in 10 years. That's sort of the idea of discounting. And I've just drawn a very simple upward sloping yield curve, and that's, I'll assume for also the examples that are gonna follow, that this is a risk-free yield curve. And then how banks are earning money is essentially through three components. And then you can vary the composition or the mix of this. So let's start with the asset side and the loans that you're giving. If you're financing a 10-year loan, and let's say the reference rate is 2% for a 10-year loan, then you can give the loan out, or if you give the loan out at 2.5% for the client, you will have a 50 basis point margin on that loan above the reference rate. Now, there's some technicalities behind that, because the reference rate, which is risk-free here, is not necessarily the funds transfer pricing, the FTP rate, which is the internal rate at which the relationship manager gets the funding from the Treasury function. So there's going to be spread above that. And also the 50 basis points here That's not all profit. So some of it is cost, just the cost of running the bank, but some of it is also expected losses, expected loss coverage. But for the sake of simplicity, let's just say you earn here 50 basis points as a margin. The same happens on the liability side. So if customers come, and let's not go into sight deposits yet, but just take term deposits that have a fixed duration. And let's say you get funding at 3 months. So it's a 3 months fixed term deposit that will also have a fixed rate attached to it. If the 3 months reference rate is 1%, and we pay the customer 0.5% on the deposit, then again you have 50 bips that you're earning on that deposit. And then there's a maturity transformation component, which is the fact that banks take in money shorter term and lend out longer term. And there in this example, you'd earn 1% on maturity transformation. So you'd have a net interest income of 2% by lending out 100 to the customer on the loan, which you funded by 100 on the fixed term deposit.
Yeah. It's so simple.
Yeah. Then the components of interest rates. The left side is how it's defined in the BCBS document that we just talked about a few minutes before. And they split it into items at amortized costs. So that's the hugest bulk of what you have in your banking book. All the loans will sit there. And items at fair value. There's a difference if you hold bonds, government bonds, for instance, or the RMBS that Silicon Valley Bank held. You can choose whether you have them as held to maturity, which will mean they're generally accrual accounted, so they would fall into the amortized cost bucket, or you can choose to fair value them. And generally, those will be fair valued because you want to have the option to sell them. If you hold bonds in a hold to maturity portfolio, which is what Silicon Valley Bank did, if you sell one bond of that book or category, you will have to fair value the entire portfolio. So selling one bond, which would generally be in a state where it's the value of the portfolio has turned against you. If you then sell the bond and it's held to maturity, you have to fair value the entire thing. So you're taking a huge loss. You're converting the unrealized loss into a realized loss in one go. So you would rather fair value, in general, your bond portfolio, because then the value of the portfolio just swings with the market, but you don't build this tail risk of suddenly having a huge write down if you were to sell it.
So why would a bank place the bonds in a hold to maturity bucket? Accrual accounting.
There can be several reasons. One is if you, for instance, don't want to, depending also on what your liability side is, one reason could be you don't really want to think too much about P&L swings. So you just want to sit on the liquidity. And let's say you're a very simple retail bank. You're earning interest income on your assets, and this gives you an income stream, and that goes into your profits and losses. And you just want to sit on the bonds for liquidity purposes without doing anything with them. If you fair value them and interest rates go up and down, then you will have P&L swings because the value of your books, of your bond portfolio, goes up and down.
Right.
But that says nothing about your business model.
Right.
Well, if you have them at amortized cost, you will not have any P&L swings generated by these bonds.
I feel like moving away from that to the diagram on the left, I feel like we have to go through it and explain exactly what's going on there, why there are different colors, and what the meaning of these different things are. I'm not sure if the vertical axis implies a yield, or maybe you can take us through it.
Yes, the vertical axis does imply a yield. So maybe let's start with the green box on the left-hand side, which is for items at fair value. You have a risk-free rate, so that would essentially be the spot rate here at well, I've marked 3 months, but it would essentially be overnight. And then you have a market duration spread. That's that's the spread that you get if you have longer durations or longer tenor. So the risk-free rate at 3 months is going to be different from the risk-free rate in 10 years.
Right. So that's
And
you called it tenor,
yes,
market duration tenor. Tenor meaning how far out does the bond mature?
exactly.
Um, then we have market liquidity
Then
spread.
we have
Okay, I
market
see.
liquidity spread, which is essentially a market wide. So market is as opposed to idiosyncratic. Idiosyncratic means it's just really specific to this individual bond. So an idiosyncratic credit spread means you have credit risk attached to this particular company, um, irrespective of a market credit spread. If you have a sector that's more credit risky than another sector, um, that's accounted for in the market credit spread. But if within that sector you have a specific company that's more credit risky than another one, then you will have an idiosyncratic credit spread. And so that's the difference between markets and idiosyncratic. And liquidity spread, I find it to be somewhat of an elusive concept, if you will. The idea is you have essentially three buckets. So you've got the pure term structure or the pure interest rate risk, where we think about risk-free rates and no credit risk attached. Then you have, as mentioned, the credit elements, and then the market liquidity spread is if you have two companies of the same credit risk and you want to lend to them at the same tenor, but the liquidity of how easily could you trade in and out of a bond if you bought a bond and then you want to get rid of it in the secondary market at some point, how easily can you get rid of that? That might be different for two companies, even though they have the same credit risk and similar other properties. Um,
Yes, we're
and I
very,
say it's a bit artificial, a bit because
it's
it's
not, it's
or
very clear.
elusive. Pardon?
Very clear to me. It's a
Because
liquid, you have you're willing to pay more for you're willing to get a lower yield on something that you can get rid of easily.
yes,
And if you can't get rid of it easily, you need to take that's a risk to
yes,
it might not be a risk to everyone, but it's a risk to the guy sitting there who has to meet some requirement that
yeah,
he may have to get rid of it, you know?
yes,
So
exactly.
and
And I say it's a bit elusive because if you look at a coupon, that's well, you get if you hold a bond or you need to pay if you issue the bond. um, that coupon is going to have all of these things
yeah,
combined. You're not compartmentalizing that coupon and splitting it out into, well, the 5% that you're getting is 2.5 on the idiosyncratic credit spread, 50 basis points on the market credit spread, 50 basis points on the market liquidity spread, and this is on the risk-free rate. The thing that you can disentangle, I think, is the purple section. So the risk-free rate, if it's a 10-year bond, then that's a 10-year risk-free rate. That's easy. You can get that from yield curves, and then the spread on top of that. But the disentangling then into the other components is quite tricky at a technical level.
tell me if what I'm about to say is helpful. Um, you're aggregating up from a risk management perspective or from a CFO's perspective of a financial institution. You're aggregating up many different fixed income instruments, and if you're trying to aggregate that up, it's very useful to break those instruments out into their different components. And so if you're looking at interest income, there's a component of that which is the risk-free rate, and you're going to do certain things with the risk-free rate. Market duration spread, again, you're going to do certain things with that. When you get to market liquidity credit spread into idiosyncratic credit spread, now you're getting into, from my perspective, what a credit analyst might be doing at a pension fund. And they will want to look at those elements. In fact, for them, risk-free rate and market duration, that's just a kind of like a funding cost. And they're going to be going in and out of there where they judge the idiosyncratic credit spread to be wrong, or they can hedge out. They can hedge out the industry risk, for example. So they will be active there. They're valid components. It's just not so valid from the perspective of the risk manager, CFO of the bank, if you like.
Yeah.
So, and so the left-hand side is
the left-hand side.
That's for illiquid low, consumer and corporate. Yeah,
exactly. That would be more non-traded assets. So loans and mortgages, where you have a funding rate or a reference rate plus a funding margin. So that relates to the funds transfer pricing, FTP. And then on top of that, you have a credit margin if it's a loan. So you'll have when you think about loan issuance, the relationship manager will get funding from the Treasury to issue the loan to the customer, which means the relationship manager or his business area, they will pay an interest rate to the banking book, to the Treasury function that manages interest rate risk in the banking book holistically. So from the balance sheet perspective, and we'll get to that when we speak about the Treasury function, we saw assets and liabilities on the balance sheet, but actually there's another balance sheet within, if you will. So the customer is going to bring a deposit, and that's a relationship between the customer and the relationship manager and his business area. That can be private banking, retail banking, business banking if the customer is a company. And then you will have another transaction inside the bank where that funding is passed on from the business area to the Treasury. And Treasury is really a bank within the bank. And the same happens on the lending side. So if the customer gets a loan from the bank, that's in a sense a relationship between the customer and the relationship manager. And the relationship manager is getting the funding for that loan again from Treasury. So you've got lots and lots of different relationship managers who have customers that they're supporting. And all of these relationship managers, they will always face the Treasury. So Treasury is a pool where all of the lending and all of the borrowing comes together. And essentially also where the maturity transformation that we talked about, I'll jump a bit back and forth now. The maturity transformation that we talked about, that's happening in the Treasury function. Whereas the asset margin and the liability margin, that will be steered by the relationship manager. So, for instance, if you have a client that you absolutely want to keep, the client is asking for a 10-year loan, then the relationship manager is going to go ask Treasury for 10-year funding. Treasury is going to tell it's going to cost you 2% in this example. And then a relationship manager will have automatic add-ons for credit risk and for expected costs, etc., and then their own margin. And they can then, of course, make a commercial decision on that margin, but they can't make a decision on the funding rate versus Treasury. That's going to be set. And Treasury then manages the interest rate risk. It's not the relationship managers that manage the interest rate risk for the individual loans. It's Treasury that manages the interest rate risk for all of the loans and all of the deposits that the bank has on its balance sheet.
If you take a sort of like one of the larger banks like Citibank, Wells Fargo, UBS, there's kind of wholesale and retail, you could call it. And how many people work in Treasury?
It's going to be comparatively very few. The Treasury function in a large global bank might be something around 50 odd people,
Yeah. And is
whereas
that,
relationship managers will be in the thousands.
yeah, yeah. And I imagine that that's a specific designated area in one of these trading floor type
Yes.
environments. And within Treasury, you're managing interest, you're managing everything. If you go back to the yield, the simple yield curve slide, you're managing everything that's not either asset margin or liability margin.
Yes.
But that I mean, there's a whole bunch of stuff that you're doing, and effectively, that's you work within that, or you report to that, or you report in
No,
parallel to
we
that.
manage the risk of that.
Yeah.
We
So
oversee that function is managing the risks that arise in that pooling process well enough.
yeah,
So
so
both,
they will have the Treasury function will have their own models and their own thoughts about how to do that. And then
yeah,
you're a kind of like a very specialized audit function, actually.
yeah, in a sense.
That if for sort of good bank management perspective, you actually don't want to be sitting in the same area because then
Yeah,
you'll get convinced by their thinking, as opposed to coming from the outside, relatively from the outside, and saying, okay, what are you guys up to?
yeah,
Which is
exactly.
effectively,
You have to have so that there's a requirement to be independent. You
yeah,
cannot sit in the same organizational hierarchy,
yeah,
because you do oversight of
yeah. And they would report to the CEO, the management committee of the board, whereas you would report to the risk management slash audit committee of the board.
so the Treasury would generally report to the CFO in the
Yeah,
board, and the risk function would report to the CRO, the Chief Risk
right,
Officer.
right.
And then the Chief Risk Officer and the Chief Financial Officer, they will sit on the management board together with the CEO.
Maybe on this
Yeah.
chart, the one on the left, although it looks more complicated up front, is actually very easy to understand once you talk through it.
Yeah.
The one on the right looks weird to me now because if you take the blue bars, the risk-free rate feels to me should be underneath the risk spread, but it's the other way around. And maybe you can talk us through that briefly. It's obviously useful in some way or other.
Yes, yes, probably it should rather be on the bottom. This is adapted from a book by Puya Faravash. It's an amazing book on asset liability management. So that I think that graph I would read it from left to right, where you've got your full yield, which quite easily decomposes into risk-free rate and then a risk spread. Um, and then the risk spread, and sorry, let's take the risk-free rate first. That's simply the term structure of interest rates. So
Yeah,
the risk-free rate spot and the market duration spread. Um, and then the risk spread, as mentioned, it disintegrates or disaggregates into market risk spread and credit risk spread.
now it's
And
making more
these in
sense to
turn
me.
also disaggregate into idiosyncratic risk spreads, market-wide credits risk spreads.
Right.
And then you've got, for instance, the prepayment risk spread, which is mentioned here in Faravash. That's not really mentioned in the BCBS
Okay.
decomposition.
Now you're making sense to me. That makes a lot of sense to me. So,
Yeah, so and prepayment risk spread, that's of course a market risk if you think about it, because if rates if rates go up or down, then that will impact the prepayment speed of your loans, if you can prepay on it. And that of course needs to be factored into your yield. So if you have a mortgage that where you can't prepay versus a mortgage where you can prepay, um, the risk-free rate on the mortgage is going to be the same. The credit risk is also going to be the same if the two counterparties are exactly equivalent. But if one has the option to prepay and the other one not, there's going to be a difference in the yield, and
yeah,
and that's driven by this prepayment risk spread.
yeah. So, I mean, it just, yeah, yeah, makes a lot of sense to me, at least. And it makes a lot of
Yeah,
sense that you are trying to pull out of a whole bunch of different instruments the bits that are actually apples to apples and
yeah,
to disaggregate and to be clear about the bits that are not. And that allows you to think, you know,
yeah. Let's maybe talk about the BCBS scenarios, because we started this
yeah,
session with delta EVE and the measures. I think that would be a nice spot to wrap up.
yeah,
Um, So these are the 6 scenarios for Swiss francs. On the left-hand side, it's a bit odd. We're showing tenors in months. So this goes up to 600. Now you have to divide it by 12. That's 50 years. Very
Yeah.
bad at mental arithmetics.
Yeah.
So from 0 to out to 50 years. And the left side shows the shocks in percent. So 1.5 is 1.5% or 150 basis points. And the 6 scenarios are essentially parallel up. That's the blue shock on the top. Parallel down is the green one at the bottom. And then you've got short rate up and down. That's short rate up is yellow. Short rate down is turquoise. And then you've got steepener and flatteners. That's the red and the purple one. So the steepener is the red one. So it means that short-term rates will go down and longer-term rates will go up. And as a result, the yield curve is going to steepen. And the flattener simply means short-term rates go up and long-term rates go down. And that's going to lead to it's going to give you a flattening of the curve. And
Is
on the
there,
right side,
yeah.
sorry?
I mean, those are logically that's a logical breakdown of what could happen on the yield curve.
Yeah.
I mean, there's you probably think up some other things, but those are kind of like either impossible or extremely unlikely.
Yes. And one question now, sort of as a teaser for whatever's going to be one of our last parts when we talk about stress testing and reverse stress testing. One of the questions we were looking into, is it actually enough to look at these 6 scenarios? And will they comprehensively cover the interest rate risk from your bank's balance sheet? Or could your balance sheet be structured in such a way that interest rate risk falls between the cracks?
Yeah. Yeah. And so,
And yes,
yeah, go ahead.
on the right, we're then simply applying these 6 scenarios to today's yield curve. In black, you've got the Swiss franc yield curve. This is about a year ago, odd.
Yeah. So sorry
A bit
for
more.
somebody who didn't, just to be clear, the vertical axis is not the same. So what you have on the left is the delta of the move, whereas
Yes,
what you have on the right is the actual yield curve. So you're going from
it's the
0 to 3.5.
interest rate.
Yeah.
Exactly.
So
So the
sorry, keep
spot,
going.
pardon?
Yeah, sorry.
The
Over to
spot
you.
rate at that point in time when we took a snapshot was about 1.5%. That's just the point, the black dashed point above zero on the right hand graph. And then you see there's a funny bump on the yield curve. And then you simply apply these shocks. So the parallel up scenario means you take that curve and you shift it up in a parallel move by 150 basis points. You shift it down, and then the curve, of course, changes its shape when you apply other shocks. So if you look at the steepener, for instance, the bump is essentially removed, and it becomes a really steep curve going up from 0.5% up to 3% from overnight out to about 10 years.
And just I'm applying some basic knowledge here, but it's worth saying central banks and policymakers can influence short-term rates a lot and have very little influence over long-term rates. And
yeah, they will try to influence long-term rates with forward guidance, sort of saying what they're likely to do in the future. They can also influence longer-term rates with bond purchases, sort of by driving supply and demand, and as a result, changing the yield in these markets. But it's much more limited compared to the power that they have in steering the short-term rate. And there's different central bank facilities, but if you think about for instance, lending or deposit facilities at the central bank, if the central bank gives you a certain rate on a deposit, that's automatically going to create a floor.
Yeah.
So if I can park my money risk free at the central bank, then I'm not going to give it away for a lower rate to a bank attached with credit risk.
Yeah. uh, the longer term tenor represents the actual demand and the actual supply of savings
Yeah.
and investment. So and th those markets are vast. I mean, I sometimes look at the size of debt capital markets, and they're many multiples of the size of equity capital markets.
Yeah.
And the attempt by a government to kind of like affect, sort of borrow more or sell assets into it, very hard to do. But short term, they manipulate the banking rules, even not even by the supply and demand of money, just by the interest rate or reserve requirements or all sorts of rules that they can use to move the interest rates around,
Yes.
basically. So yeah.
And
Um,
and this is really what the supervisory outlier tests are about. You take today's yield curve, you change it in a prescribed way. 6 scenarios for EVE, 2 scenarios for NII. So only the parallel up and parallel down because it's a short 1 to 5 year horizon. And for the supervisory outlier test, it's actually just a 1 year horizon. So then all that really matters is your short term rates, what happens with them, and then you just bump them up and down. And then you look at what happens to your balance sheet under these 6 scenarios. And that's where Silicon Valley Bank then reported a 28% decrease in its economic value if rates were going up by 200 basis points.
Parallel,
Let's say
I
200
suspect.
basis points parallel. So here, this is both the shocks and the recalibration of shocks. So after rates have increased substantially since 2021, the standardized shocks that we had in place since 2016 were then updated by essentially larger shocks in most currencies. So you can see the parallel ones. And you generally say 200 basis points because it was 200 basis points for most of the currencies, especially in euros and also in dollars. In dollars, it still is 200 basis points. But you can
So
see that they've
just to
changed. Sorry?
just to explain this chart, what you've got here there along the top is the different currencies, Canadian dollar, Swiss francs,
Exactly.
GBP, Indian rupee, and then you've got the mandated uh, um, shifts in the risk curve that the Bank of International Settlements is asking you guys inside the risk departments to model. Have I got that right?
Exactly. Exactly. That's exactly it.
And
And
I
you
think that if you
can't
go,
direct, sorry?
yeah, if you go back to the previous chart, I think something that stands out to me is that so you've shocked 200 basis points, but based on my lifetime, I mean, when I was, I guess I was still in high school, but interest rates in the US were above 10%. And so I kind of find myself wanting to see, if I was in the risk
Yeah.
department, if I was working with you, I'd say, hey, Eric, let's take a look at what happens if it goes to 5%, 7%, 9%, just to see, how's it looking?
That's what a lot of banks do. I don't know if a lot, but that's what some banks do. Um, and it's also in a sense required by regulation because the regulation asks you to look at other scenarios above and beyond these. And it's an absolutely fair question. We've seen rates at double-digit percentage numbers. So with rates at 1.5, 2, 3, or 4%, if we change them by 2%, we're still at single digits. So these are not extreme scenarios,
Oh,
if you will. However, these scenarios are so for NII, it's over a 1 year horizon, and for EVE, it's essentially an instantaneous shift in the yield curve. So a two to
yeah,
300 basis point instantaneous shift is of course massive. Um, the question then really depends on what's the duration of your balance sheet and how quickly is that going to reprice. If you've got 10-year duration, then of course it will hurt you if interest rates rise quickly. But if you've got a relatively short duration book, if interest rates go up quickly, then you will keep repricing quickly as well. And if your gap risk is small, so your assets and your liabilities reprice at the same time, then essentially you're like a boat with floating on the water, and the water level goes up, your boat goes up as well, and there's no risk in that, but you're more like a pass-through engine of
Yeah.
no.
By the way, something that I would just, and I'll close on this last comment from me because now we've gone at least 5 minutes. I thought longer than we expected to, is many of the concepts that we're looking at apply to individuals as well. So you can look at an individual, it's slightly different, but you can look at, lifetime spending patterns, lifetime earnings patterns. You see many, Ross Perot, just to take one example out of the air, was a very wealthy guy who was on the asset side of his balance sheet. He'd sold his business and he just kept it all in cash. And so there was a mismatch between the duration of his foreseen liabilities and his assets, for example. So there's ways to think this can help you to think about your own balance sheet as well. I mean, it was probably many orders of sophistication greater than one needs, but the tools are useful. So
Yeah.
Eric, I want to thank you so much. When we just agreed to do this, we were going to kind of just do one session on this, and in a break we just agreed that Eric's having fun, I'm having fun, and so we're going through it slowly, and maybe there'll be one or two listeners who enjoy it as well. But I wanted to thank you so much for taking the time
Thank
to
you.
do this. And so we will see you again next time. Why don't you just do the preview of what's next? I guess you'll be able to just move to the next video. But
I can do preview, yes. So we'll talk about NII and EVE, doing an actual example, going through that. Briefly talk again about the Treasury function and how the funds transfer pricing works, and then let's see if we do get there, and then I think I'll stop the teaser here, talking about gap risk, and sort of mapping the balance sheet to what's called the gap profile, and see how we can identify risks that arise if we do long-term lending with short-term funding, and how that would precisely pop up in the gap profile.
So there's the preview. Eric, thank you so much, and
Thank
see you
you.
all next time. Thank you for your patience with me and all my interruptions.